Oh no, it finally happened. The US's AAA credit rating was downgraded to AA plus by Fitch. But is that really a sign of what's going on with the economy? And are we actually trending towards recession? Or do the ADP numbers that just came out tell us something different? Well, let's analyze all of this together. So, first, many bears are already cheering that finally the US has had its credit rating downgraded. And quite frankly, you can't really blame Fitch for downgrading the United States' credit rating. After all, they have a fancy way of saying 11th hour resolutions have eroded confidence in our ability of the government to essentially not default on its debt. It's the fancy way to basically say we're tired of the political drama in Congress. And basically our politicians not getting off their ASS and getting things done, like managing our fiscal house. Fitch isn't exactly wrong when they compare the United States to other AAA-rated countries, where other AAA-rated A countries have around 39.3% debt compared to their GDP. I know that sounds complicated, but think about it for a moment. If our GDP is $100 and our debt is $39.3, then we're about in line with other AAA-rated countries, whether those are, Germany or other countries that are AAA-rated. When we compare to America, though, we go, oh, America's at over 100% debt to GDP, and we expect to be at 118% of debt to GDP by 2025. That's not great. Now, most of the AAA-rated countries, again, averaging 39.3%. Germany a little higher on that, others a little lower on that, but still most of them much lower than the United States. And the drama we've got going on here are honestly reasonable, that you would expect a downgrade here. Fitch warned us that something like this was coming. It happened in August of 2011 before, when Standard & Poor's, the S&P, downgraded us as well. And we could see how the market reacted then. It expectedly wasn't good, but it was transitory. Take a look. This is Webull, and it shows you this drop right here, which was actually already occurring because of the European sovereign debt crisis. Again, big fancy words here. Let me just put it this way. You've heard of the euro, right? The euro currency used in euro. Okay. Well, in 2011, it was undergoing a massive real test of existence. There was an existential crisis of, is the euro actually going to be able to survive? Are people actually going to trust this paper money? And the euro survival came into real question during this time. That led to additional heart palpitations, but if you zoom specifically past some of the red that started here at the beginning of August 2011, and you go specifically to August 5th, you on August 5th had, and this is on the average candlesticks mode, so what I always like to do is when I want to know what actually happened that day, I try to go to the non-average candlesticks. That's generally important. You had about a 0.62% drop on August 5th. Usually they make these announcements after the market closes. So that means the next day what happened? Oh, the NASDAQ fell 6%. 6% the day after the S&P downgraded the United States. And guess what promptly happened after the 6th? Let's go back to our average candlesticks. Mind you, the 6th is right about here. Let's zoom out. And as you can see, this ended up being a whole load of nothing. Because over the next decade, that would have been a great opportunity to potentially buy the dip. As you can see, the market trended up. Some pain over here in 2018, and then of course we get COVID pain again, and then somewhere over here we get our 2022 pain, and then we have our Nike swoosh recovery. And what are we dropping today on the Qs? About 1%. It's probably going to be a little bit of a red week thanks to this downgrade. But what is the actual economy doing? Is this something we should really be fearful of, or are the bears winning here? Because theoretically, a downgrade of our U.S. credit rating should increase Treasury yields. Excuse me, I had like It's such a long day yesterday, so my voice is a little lost. We traveled to 2 different states and saw about 15 different properties for my real estate startup, House Hack. By the way, we're probably going to be raising money for that with non-accredited investors very, very soon. So go to househack.com if you want to sign up for notifications on when that's ready. But anyway, we did have a slight move up on yields. We have the 10-year moving up to 4.08%. However, this is happening at the same time as we have a larger Treasury auction. It just basically is reiterating what Fitch is saying anyway, and that is we're issuing too much debt. Our fiscal house is a disaster in our government, so it's really not a surprise we're getting downgraded here. But it does reiterate this idea that, we might end up seeing higher yields for longer, which is also very important to pay attention to if you are a real estate investor, because higher yields for longer could eventually start biting real estate prices more than what we saw in the second half of last year. So it's a lot to pay attention to, but there are going to be some great opportunities. So what did we just get, though, about the economy? Well, we had an estimate for an ADP labor report of 190,000 jobs. And this is very important because it's also going to give us a guide of, are we going to get inflation-free growth, or are we going to grow and reanimate inflation? After all, that's what the bears say. The bears say we're going to have growth and then we're going to reanimate inflation. Or we're going to get recessionary figures and then we are going to have inflation as we stimulate again. That's the bear argument. Well, the bear argument so far isn't looking very good. Bank of America just became one of the first major banks to withdraw their recession prediction. They just flip-flopped on that today. That's a massive flip. No recession call anymore from Bank of America. And we had a 190,000 job estimate for the ADP employment report. And what did we get, folks? We got an unemployment, or a jobs report for ADP. This is the private sector jobs report. We'll get the government version on Friday. I like to call this the report to keep the government more accountable. Tough to keep them perfectly accountable. We should be able to, but we can't. But anyway, private sector employment increased 324,000 jobs in July. Oh no, is the economy overheating? Are we going to have to raise rates? Oh, well, let's find out. Oh, look at this. Median change in annual pay, 6.2%, and for job changers, 10.2%. How does that compare to last month? Well, last month we were at 6.4 and 11.2. In other words, we are decelerating faster, and we are now at the lowest pace of job wage gains since November of 2021. This is fantastic because it means workers are still making more money, but the rate of growth is slowing down. You'll notice that it's larger employers that are adding fewer jobs. Actually, they're contracting. And it's the smaller businesses that are adding to the labor force more, with the bulk of the job gains coming from smaller establishments, which is also interesting because the small firms are the ones offering the lowest pay increases, which is actually what you want to see. And expectedly, most of the jobs are coming from leisure and hospitality, where we have contraction in manufacturing. Yes, a lot of people look at manufacturing and say, but is that a leading indicator of everything collapsing? Not necessarily, especially since manufacturing is an interest rate sensitive industry. Look at the pain that you're seeing at an Enphase or potentially even a stock like Tesla. These are very interest rate sensitive industries. Now, of course, they are off some of, Tesla at least is off some of its lows that it saw at the end of last year. But usually what happens is you need interest rates to start falling, and then you could see an explosion in manufacturing stocks again. So that gives a potential opportunity to buy the dip off of some of these Fitch downgrade. S&P downgrade was back in 2011. So this is actually a very, very strong report, and it's, quite frankly, a good thing. So congratulations to the U.S. economy. Now, some people wonder, how can you sustain this? You can't keep this going. At some point, it's going to lead to more inflation, right? Not necessarily. That's because we have a chart here that talks about labor force participation. The red line is the trend line. Guess where we are? Oh my gosh, unsurprisingly, we are below trend. Bears have a really bad tendency of ignoring what the trend is. bears have a really bad tendency of just trying to compare to changes that only happened since COVID and not comparing to pre-COVID levels. And when we actually compare to pre-COVID levels, we have more room to grow, getting more people in the labor force without actually creating inflation, because we're adding workers to the labor force. This is fantastic, because when you increase the supply of labor, you can expand an economy without high wage gains. Remember, the target for wage gains is about 3%, so still above target, but we already know that even Jerome Powell is willing to be patient on this number. So, this is actually, in my opinion, all fantastic news. The Fitch downgrade was expected. It's not that big of a deal. China is trying to stimulate, but they have their own sets of problems. I guess now they want to ban minors from using the internet from 10 p.m. to 6 a.m. And I mean, we all know that's when all the best gaming happens. So it's kind of crazy. I guess they're going to fall behind on all that Rust gaming they could be doing. Okay, anyway, we talked about Bank of America revoking its inflation forecast. We talked about labor force participation rising, but still below prior trend. Talked about the ADP blowout. We've got the jobs report coming out on Friday. I'll be live for that at 5:30 a.m., so stay tuned for the jobs report on Friday. Go to househack.com so you can sign up for notifications on when we're available to raise money from anyone. We're still going to have that same one-to-one valuation, which is extremely rare for a startup. For a startup to raise money on a cash valuation is insane. Nobody does that. It's insane. It's my way of giving back to my subscribers because my goal is to take this company to IPO. That's my hope. So, yes, we have a little bit of a move up on treasuries, and yes, we would expect some pain in stocks because of this downgrade, but then again, it's probably a near-term buy the dip opportunity, although we wonder how much the dip will continue to dip, because right now it is dipping. Anyway, thank you so much for watching. Hopefully this was insightful, and we'll see you in the next one. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.